Here's a true story. Well, true in the sense that it happens in some version in almost every single divorce. A couple, married 11 years, had navigated custody of their two children, the house, the cars, and the retirement account worth $500,000 without more than a few difficult conversations. And then someone brought up the Vitamix. Suddenly there were emails and texts. There were angry emotions going back and forth. There was at one point a text message that said, and I'm paraphrasing, "You never even used it. You just want to hurt me because you know I want it." Nobody cares about the couch until it's time to split the Vitamix. Here's what I want you to hold on to today. You cannot divide a Vitamix. You can't cut it in half. You can't rotate custody of it. Someone gets it, someone doesn't. And the question is, how do you get to that decision without spending more money on attorneys than the actual Vitamix? Today's episode is your practical field guide to property division. By the end of today's session, you will know exactly what's normal, what's negotiable, and how to avoid the expensive fights that drain the estate you're both trying to protect. Let's get into it. Welcome to the Conscious Divorce Podcast. I'm Justin Milrad, and this show exists because divorce doesn't have to be the worst thing that ever happened to you. Done right, with the right information, the right support, and the right mindset, it can be the beginning of a life you were always supposed to be with. Before we dive in, I need to be clear about something important, and I want you to hear this, not just skim past it. I'm not an attorney. I'm not a therapist. I'm not a doctor, a financial advisor, or a CPA. I am a certified divorce coach. Everything I share on this show is for educational purposes only. It's not legal advice, financial advice, mental health treatment, or medical guidance. The topics we cover today, property division, retirement accounts, business valuation, debts, these are all areas that have rules, laws, and practices that vary significantly depending on where you live. What's true in California may be completely different here in Georgia. What a judge does in one county may not reflect what a judge does in the next. I will do my best to give you accurate, well-researched frameworks, but your specific situation requires professionals who are licensed in your state and who know the details of your case. Please consult a family law attorney for legal guidance. Work with a financial advisor or certified divorce financial analyst for financial decisions. See a licensed therapist or counselor if you're navigating the emotional weight of what you're going through. These professionals exist for exactly this moment in your life, and no podcast, including this one, replaces them. I'll remind you of that throughout this episode, not to be annoying, but because I genuinely care about you getting this right. Okay, with that said, here's where we're going today, because we are covering a lot of ground. First, we're going to talk about the Vitamix Principle, why small things become enormous, and how to diffuse that before it costs you thousands. Then we'll walk through the big buckets of property, everything from real estate to retirement accounts to digital assets, and break down the difference between marital and separate property in plain English. We'll cover community property versus equitable division, because the state you live in shapes everything about how your assets get divided, and most people don't know that until it's too late. Then we'll spend serious time on the 10 biggest flashpoints, the things that reliably blow up divorces, with real examples and real resolution paths for each one. We'll get into practical frameworks from dividing things that literally cannot be divided, 8 creative methods that actually work, and a section I'm calling How to Stop the Bleeding, because the biggest cost in most divorces isn't the settlement, it's the fighting. And we'll close with practical tools you can use this week, an inventory method, a negotiation script, a mediation checklist, and the signals that tell you it's time to bring in a professional. Let's start where all the trouble starts. The Vitamix Principle. There's a reason the Vitamix becomes the battleground. It's not about the $600 retail price. It's not even really about the smoothies. It's about the fact that somewhere along the way, that blender stopped being an appliance and became a symbol of the kitchen you built together, of Saturday morning routines, of a life that's now ending. When you fight for the Vitamix, you're really fighting to not disappear from the story of your own marriage. This is what I call the Vitamix Principle. The smaller and more specific the item, the more likely that it is to have emotional value that is completely decoupled from its market value. The couch is $800 at retail. No one cares about the couch. But the handmade quilt your ex's grandmother made, zero market value, infinite emotional value. That's where the wars happen. So how do you diffuse a Vitamix standoff? Step one is naming the dynamic. When you recognize that you're fighting for a symbol rather than an object, you have choices a symbolic fight doesn't give you. You can ask, what am I actually trying to protect here? Answering that question honestly opens door. Step two is separating market value from sentimental value. They require different negotiations. If an item has real market value, a piece of art, a piece of jewelry, an antique, you get an appraisal. That gives you a number both parties can argue against rather than feelings neither party can resolve. If an item has primarily sentimental value, the negotiation shifts to who needs this more and what are they willing to trade for it. Step three is refusing to let a $300 item cost you $3,000. I've seen this over and over again. It's one of the most human parts of divorce and one of the most expensive if you let it run. The big buckets of property. Before we talk about what's negotiable and what isn't, we need a shared vocabulary. Because one of the things that makes property division feel so overwhelming is that people don't know what they're actually dividing. Let me give you the buckets. Real estate, your primary home, vacation homes, investment properties, timeshares, land, usually the largest single asset in the marriage and often the most complicated because it's tied to a mortgage obligation, equity, and in many cases, the children's school district. Bank and financial accounts, checking, savings, money market, CDs, joint accounts are almost always marital property. Separate accounts are maybe separate property, depending on where the money came from and how it's managed. Retirement accounts, 401ks, 403bs, IRAs, pensions, deferred compensation plans. These require special legal instruments to divide without triggering taxes and penalties. We'll talk about quadros in a few minutes. Vehicles, cars, trucks, motorcycles, boats, RVs. Easier to value than most assets, but can get complicated when leases, loans, or business use are involved. Business interests. An ownership stake in a business, whether it's a small LLC, a professional practice, or shares in a closely held company. One of the most contested areas in high-income divorces. Investment portfolios, brokerage accounts, stock holdings, bonds, mutual funds. Relatively liquid, relatively easy to divide, except when the tax basis becomes a factor. Debts, mortgages, car loans, student loans, credit cards, personal loans, business loans, tax debt. People forget that you're not just dividing assets, you're dividing liabilities too. Digital assets, cryptocurrency, NFTs, airline miles, hotel points, subscriptions, digital businesses, monetized social media accounts. Courts are still catching up in this category, but it is marital property. Intellectual property, royalties, patents, book deals, music rights, especially relevant ones where a spouse is a creative professional or inventor. Personal property, everything else, furniture, appliances, jewelry, art, collectibles, sports equipment, musical instruments, the wine cellars, the tools in the garage, the heirlooms, and then, of course, the Vitamix. Now, here's a concept that unlocks all of this. Marital property versus separate property. Marital property is generally everything acquired during the marriage, regardless of whose name it's in. You bought a car during the marriage with joint income, marital property. Your employer deposited your 401k contributions during the marriage, that portion is marital property. Your spouse's name doesn't need to be anywhere on it. Separate property is generally what you owned before the marriage, plus gifts and inheritances received during the marriage from a third party, as long as you kept them separate. Your grandmother left you $50,000 while you were married, and you put it in a separate account you never touched. Probably separate. Of course, check with your attorney. You deposited it into a joint checking account and used it to pay the mortgage for 3 years. Well, there's a good chance it's commingled. This is where commingling comes in. Commingling is what happens when separate property gets mixed with marital property. The tracing nightmare, the forensic accountant's job, the thing that turns a simple case into an expensive one. A quick example. You own a condo before the marriage. You get married. Your spouse moves in. You both use joint income to pay the mortgage for 8 years and fund a major renovation. What's marital? What's separate? The answer depends on your state, your documentation, and in a contested divorce, potentially the testimony of a forensic account. The lesson. Separate property is only protected if you treat it as separate. Document it. Keep it in its own account. Don't mix it. And talk to an attorney early if you think you have separate property to protect. Quick reminder, everything I'm sharing is educational, not legal advice. Your state's rules govern what happens in your divorce, and you need a licensed attorney to advise you on your specific situation. Community property versus equitable. Okay, question everyone asks. Do we split everything 50-50? Maybe, but probably not exactly. Here's a framework. 9 states use common property rules. California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, Wisconsin, and New Mexico. In these states, the presumption is that marital property, everything acquired during the marriage, belongs equally to both spouses and is divided 50-50. There are exceptions. Separate property, gifts, inheritances, but the baseline presumption is equal. The other 41 states use equitable distribution. And equitable doesn't mean equal. It means fair, as determined by a judge, or ideally by 2 of you in negotiation, using a list of statutory factors that varies by state, but typically includes the length of the marriage, each spouse's financial, non-financial contribution, each spouse's current and future earning capacity, age and health of each spouse, standard of living established during the marriage, custodial responsibilities, any prenuptial agreements. In some states, marital misconduct. What does this mean practically? In a long marriage where one spouse left the workforce to raise children and has limited earning capacity, equitable might mean 60-40 or more in favor of that spouse. In a short marriage where both spouses came in with roughly equal assets and roughly equal incomes, equitable might look like 50-50. The key insight is this. In equitable distribution states, the outcome is not predetermined. It's negotiated or litigated. That's why you negotiate matters and why the frameworks we're about to talk about are so important. One more concept to flag here, the date of valuation. Courts generally value marital assets either at the date of separation or the date of the trial, and which date applies varies by jurisdiction and sometimes by asset type. This matters enormously for assets that fluctuate, stock portfolios, businesses, real estate markets that move significantly during a long divorce proceeding. Your attorney will advise you on the applicable rules in your state, but going in knowing that when something is valued can be as important as knowing how it's valued. The 10 biggest flashpoints. All right, let's talk about the things that reliably blow up divorces. I've seen these hundreds of times, and I want to give with each one what it is, why it triggers conflict, and how it typically resolves. Flashpoint 1, the family home. What it is. The primary residence, usually the largest asset and carrying the most emotional weight. Why it triggers conflict. Kids' stability arguments collide with financial reality arguments. I need to keep the kids in the school district. Neither of us can qualify for this mortgage or loan. How it resolves. 3 common paths. 1, sell it and split the proceeds. Clean, final, and often the smartest financially. 2, one spouse buys out the other and refinances in their name alone. 3, deferred sale, sometimes called nesting, where one spouse stays with the kids for a defined period, say until your youngest turns 18, and then the home is sold. Deferred sale sounds appealing, but carries real risks, maintenance responsibilities, continued financial entanglement, and the challenge of both parties qualifying for the house in the meantime. Flashpoint 2, retirement accounts. What is it? 401ks, pensions, IRA, often the second largest asset. Why it triggers conflict. People resist giving up retirement savings they view as theirs. The mechanics of division are unfamiliar and feel risky. How it resolves. Employer-sponsored plans, 401ks, pensions, require a qualified domestic relations order, also known as a quadro. A court order that instructs the plan's administrator to divide the account. Done right, it's a tax-neutral transfer. Done wrong or skipped entirely, a non-employee spouse gets nothing. IRAs are divided through a transfer incident to divorce, a slightly simpler but still legally specific process. This is educational, not legal advice. Please work with an attorney and financial advisor on quadro specifics. Flashpoint number 3, the business. What it is. An ownership interest in a business from a solo professional practice to a multi-partner company. Why it triggers conflict. Valuation is inherently subjective. The operating spouse often argues the business is worth less. The non-operating spouse often argues it's worth more. Both hire their own expert. Their experts disagree by hundreds or even thousands, sometimes even millions of dollars. How it resolves. Either a negotiated value both parties can accept, a court-appointed neutral appraiser, or in some cases, the operating spouse buying out the other's interest over time through a structured settlement. We'll come back to case story number 3 on this one. Flashpoint 4, stock options and RSUs. What it is: equity compensation, right to purchase stock or receive stock grants, often on a vesting schedule. Why it triggers conflict. The unvested portion is the gray zone. I earned those options after we separated, but you were granted them for work you did during our marriage. How it resolves. Courts generally apply a time-based formula. The portion of the vesting period that overlapped with the marriage is marital, the rest is separate. This requires careful documentation of grant dates, vesting schedules, and the date that matters legally in your jurisdiction. Highly variable by state and plan. Definitely a spot to involve a CDFA or attorney. Flashpoint number 5, marital debt. What is it? Any debt incurred during the marriage: mortgage, car loans, credit cards, student loans, personal loans, tax debt. Why it triggers conflict. Spouses often have different relationships with debt. That was your credit card, but we both benefited from it. How it resolves. Debts are allocated as part of the overall settlement, ideally with each spouse taking on debts that are tied to assets they're keeping. You keep the car loan. The critical warning: even if your divorce decree assigns a debt to your spouse, the creditor isn't bound by that. If your name is on the account and your spouse stops paying, your credit takes the hit. Ideally, joint debts get paid off in the settlement or refinanced in the responsible party's name alone. Flashpoint number 6, the house versus the retirement trade. What it is: the classic negotiation trade-off. One spouse keeps the house, the other gets a larger share of the retirement assets. Why it triggers conflict. On paper, it looks clean. In practice, the spouse who keeps the house often can't sustain it financially, and the spouse who gives up on the house often gave up the liquidity they needed. How it resolves. A financial planner or CDFA can model the long-term net worth trajectory of both options. The house isn't just equity. It's ongoing taxes, maintenance, and insurance. A retirement account grows tax-deferred. These are not equivalent assets, and understanding the difference before you agree is critical. Flashpoint number 7, heirloom and sentimental items. What is it? Items with low or no market value but high personal significance. Grandmother's ring, the grandfather clock, handmade furniture, family artwork. Why it triggers conflict. Sentimental value is subjective and non-tradable. You can't compensate for, this was my grandmother's. How it resolves. The cleanest path. Items that originated in one family return to that family. The trickier path. Items that were gifts to the couple or items where both parties have genuine attachment. Mediation and package deals work well here. I'll trade you the China for the can. Flashpoint number 8, digital assets and biz. Bitcoin, Ethereum, NFTs, brokerage apps, airline miles, hotel points, digital collectibles, monetized YouTube channels, digital storefronts. Why it triggers conflict. Valuation is volatile, documentation is poor, and many of these assets aren't on anyone's radar until the discovery process. How it resolves. Treat cryptocurrency like any other investment. Get current valuations, document wallet addresses, agree on the data valuation, and divide or offset against other assets. Miles and points. Check the program transfer rules. Some allow transfers, some don't. Flashpoint number 9, pets. What it is: dogs, cats, horses, beloved family members who are legally classified as personal property in most states. Why it triggers conflict. Because calling a dog personal property to the people who love it feels like a category error, and it is, but the law mostly doesn't care. How it resolves. Most couples negotiate a practical arrangement. The parent with more time and space takes the pet, or a shared arrangement is built into the settlement. Yes, a dog custody schedule is a real thing, even if courts don't technically order it. A few states now allow courts to consider pet well-being. Most don't. Check your state. Flashpoint 10, Commingling inheritance or premarital assets. What it is: money or property you brought into the marriage or that you received as a gift or inheritance during the marriage. It got mixed with joint assets over time. Why it triggers conflict. The person who owned it originally feels strongly that it's theirs. Their spouse can point to years of commingled use, and they're both partially right. How it resolves: through tracing, a paper trail that documents the origin and path of separate funds. If you have clean records, a separate account that was never mixed, statements showing the inheritance sat untouched, you have a strong argument. If the money moved around and was used for joint purposes, the argument gets much harder. The lesson, again, keeps separate property truly separate. You just can't divide a toaster. Let's get practical. There's a whole category of assets in your marriage that cannot literally be divided. The house, the Vitamix, the toaster, the dog, the Peloton, the single car you own between you, the timeshare, the one good piece of art. So what do you actually do? Framework number one, buyout. One party pays the other for their interest, this requires agreeing on value, hence the appraisal. Works well for big items, house, car, and can work for smaller items if both parties agree on price. I'll pay you $300 for the Vitamix. Done. Framework number two, sell and split the proceeds. You sell the item on the open market and divide the cash. The cleanest outcome for items with real market value, often the most emotionally difficult. Framework three, trade-offs, otherwise known as horse trading. You keep the Vitamix, I get the Peloton. You keep the bedroom set, I get the living room furniture. No cash changes hands. You trade items of roughly equal value across categories. This works best when both parties can stomach approximate equity. Framework four, the pick list, draft method. Create a complete inventory of personal property. Take turns selecting items, like a fantasy draft. Each person picks one item, then the other picks, alternating until the list is exhausted. This method is fast, relatively fair. It takes the negotiation off individual items and puts it into a structured process. Framework five, neutral third-party appraisal. Items where value is genuinely in dispute. Art, jewelry, antiques, collectibles, wine. Bring in a credentialed appraiser. One number agreed upon in advance is binding, cuts through the emotional noise. Framework six, mediation package deals. Group items into bundles and trade bundles. Package A includes the kitchen appliances and the outdoor furniture. Package B includes the bedroom furniture and the basement gym equipment. Bundle trading reduces the per item negotiation load and lets people prioritize their must-haves. Framework seven, coin flip, drawstrings. Items of genuinely equal value where both parties want the item and no amount of conversation is going to resolve it. Flip a coin. Yes, really. The randomness removes the interpersonal dynamics and gives both parties a face-saving way to accept the outcome. Use it fairly and by mutual agreement, but don't dismiss it. Case story number one, the Vitamix kitchen war. Marcus and Diane had divided almost everything smoothly. House was sold, retirement accounts were allocated, custody was settled. Then they got to the kitchen. Both wanted the Vitamix, the good knife set, the stand mixer, and the cast iron collection. They were stuck for 2 weeks, and every email about it was growing hostile. Their mediator introduced a modified pick list. Each person wrote down their 5 must-haves from the kitchen. Marcus's list, Vitamix, the cast iron, the good chef's knife, the sous vide setup, and a coffee grinder. Diane's list, stand mixer, the Vitamix, the wine glasses, the Dutch oven, and the good chef's knife. The overlap was the Vitamix and the chef's knife. The mediator said 2 items, coin flip. Both agreed. Marcus won the Vitamix. Diane got the chef's knife. Everything else sorted out from there in about 20 minutes. The total time in mediation to resolve the entire kitchen, 90 minutes versus 2 weeks of hostile emails and thousands of dollars spent on attorneys. Creative division methods. Let me give you 8 methods that actually work, drawn from real mediators and settlements. Method 1, the fantasy draft. I mentioned this. It deserves a full treatment. Create a master list of all personal property. Both spouses review and number each item, 1 through 100 or however many there are. You flip a coin to determine who picks first. Then you alternate. 1 picks at a time until everything is selected. No arguing about individual items. Each person simply picks what matters most to them in that round. Fast, surprisingly equitable, and there's something oddly satisfying about it. Method 2, sealed bid. For a single contested item, both parties write down what they'd pay for it on paper, seal it, and reveal simultaneously. Whoever bids the highest gets the item and pays the other party half the difference from the midpoint. For example, if you bid 400 and I bid 700, you win and pay me $150, half of the $300 difference. This incentivizes honest bidding and creates a clear resolution. Method 3, must have, can't live without. Each spouse labels every item on the inventory as either must have or can't live without. Items where only one spouse says must have, no discussion. That person gets it. Items where both say must have, those go to the contested list for further negotiation. This dramatically shrinks the number of items in dispute. Method 4, points allocation system. Assign a point value to every item based on an agreed upon or appraised value. Each spouse gets half the total points to spend. They bid their points on items until both point budgets are exhausted. This creates a natural market that surfaces what people actually value versus what they're claiming to value for strategic reasons. Method 5, equal credits auction. Similar to points, give each spouse a notional credit equal to half the appraised value of the total personal estate. They bid credits to a live auction, can be facilitated by a mediator. The highest bidder wins. If one party consistently wins items at that price is above their credit allocation, then write a check to the other for the overage. Method 6, sentimental item swaps. This one's elegant in cases involving family heirlooms. Both parties identify items of purely sentimental value, things from their families of origin. Agreement. Items originating with your family go to you. Items originating with my family go to me. Shared sentimental items, things you accumulated together. Go through another method. This removes an entire category of conflict. Method 7, photography inventory day. Before any negotiation begins, schedule a day where both spouses, and ideally a neutral third party or their respective attorneys, walks through the home and photographs every item. You're not dividing anything that day. You're just documenting. This single step prevents enormous conflict later because it eliminates that was never in the house arguments and creates a shared record. Method 8, the deferred sale with rules. For the house, if neither party wants to sell immediately, a deferred sale agreement can work, but only with clear rules. Who lives there? Who pays a mortgage, taxes, insurance, and maintenance? How are major repairs authorized and paid for? What's the trigger for sale? A date, a child's graduation, a remarriage. Without written rules, deferred sale agreements become ongoing conflict generators. With them, they can be practical bridges. Case story number 2, the house versus retirement trade. Elaine and David had been married for 19 years. Their house had $320,000 in equity. David had a 401k worth $410,000. Elena had a smaller retirement account worth about $95,000. Elena wanted to keep the house. Their kids were teenagers. She wanted them to finish high school in their home. David agreed in principle, but wanted the math to work. The trade they almost made. Elena kept the house. David would keep his full 401k. On paper, $320,000 versus $410,000, plus David's smaller account offset felt roughly workable to them. Then a CDFA ran the numbers. If Elena kept the house without refinancing, she'd be carrying a $2,400 a month mortgage on a $68,000 salary. Her take-home after tax was about $4,200 after housing costs. She'd have less than $1,800 a month for everything else, and she'd have virtually no liquid retirement savings. The CDFA modeled an alternative: sell the house, split the equity, divide the retirement accounts proportionally. Elena came out with $160,000 in cash and a retirement account headed towards $180,000. Plus, she moved into an apartment at $1,800 a month and had a genuinely sustainable financial life. She cried when she agreed to it, but she called her CDFA 2 years later and said it was the best financial decision she made in regards to the divorce. The lesson: don't make the trade until someone models the long-term path. This is critical. Case story number 3, the business valuation dispute. Sam and Leah had been married for 12 years. Sam ran a successful marketing agency, 14 employees, about $4.2 million in annual revenue, and profit margins around 22%. Sam's appraiser valued the business at $1.1 million. Leah's appraiser valued it at $1.9 million. The $800,000 gap came down to 3 things: goodwill methodology, how much of the business value was tied to Sam's personality versus the company systems and client relationships, the normalized earnings calculation. Sam's appraiser made adjustments for owner perks, Leah's didn't, and the capitalization rate applied to the income stream. They spent 8 months and close to $120,000 in combined legal and expert fees before agreeing on a court-ordered neutral appraiser. The neutral appraiser came in at $1.45 million. Sam paid Leah $725,000 in a structured settlement over 5 years, secured by the business assets. The lesson: in business valuation disputes, a neutral appraiser appointed early saves enormous time and money. The fight and hope our expert wins approach is expensive and uncertain. How to stop the bleeding? I want to give you some math because it changed the behavior of almost everyone I've shared it with. The average family law attorney in the United States charges somewhere between $250 and $500 per hour. In major metropolitan areas, New York, LA, Chicago, Atlanta, it's more like $400 to $600 an hour. So let's use 400 as our number. A single contested hearing on personal property, preparing, attending, and following up can easily consume 3 to 5 hours of attorney's time on each side. That's $1,200 to $2,000 per side, or $2,400 to $4,000 in combined hourly fees of marital money for a $600 blunder. I'm not making this up. I've seen it. I've actually seen people spend $500,000 fighting over something like $15,000 worth of stuff just because they wanted the final word. The decision rule I recommend to every client: if the cost to fight exceeds the cost to replace it and move on. The Vitamix costs $600 new. If fighting takes more time than 90 minutes of attorney time, you've already spent more than what it's worth. Buy a new one, bank the time, and protect your resources for the things that actually matter. Here are 3 practical anti-escalation rules. Rule 1, set a floor. Agree with your attorney that you will not litigate any item worth less than X dollars. Pick a number, 500, 1,000, whatever makes sense given your estate. Items below this floor will get resolved through the draft method or a coin flip. Rule 2, document everything before you negotiate anything. The photography inventory day I mentioned, do it. Walking through with a neutral third party, photographing and logging every item takes about half a day and prevents weeks of "that was never in our house" disputes. Documentation is the negotiation infrastructure. Rule 3, build a let it go budget. Decide in advance that you're willing to absorb some amount of imperfect outcomes on personal property in exchange for faster resolution. Maybe that's $2,000 worth of items. Maybe it's $5,000. But having a pre-decided limit helps you avoid the creeping escalation where the small fight builds on the last. And finally, track the bleeding as you go. Know what you're spending on your divorce each month. If you're spending $4,000 a month in attorney fees and you've been in litigation for 8 months, that's $32,000. That's money that was part of the marital estate. Every dollar spent fighting is a dollar neither party receives. Keeping that number visible is one of the most powerful tools for motivating a settlement. Let's get back to the tools. These are the things you can actually use this week. Tool 1, the personal property inventory method. Get a notebook, a spreadsheet, or on your phone's notes app. Walk every room of your home. For each item above $50 in value, note item name and description, approximate age and condition, estimated current market, not what you paid, what it's worth today. You check things like eBay, Craigslist, or Facebook Marketplace for comparables. Who wants it? You, your spouse, both, neither, sell. Category: kitchen, bedroom, art, electronics, tool, outdoor, etc. Group items into 3 lists: your must-haves, items you're willing to trade, and the items you'd rather sell. This becomes your negotiation method. Tool 2, the negotiation script, or I want the Vitamix. Here's a script you can actually use. I want to be direct with you. The fill in the blank is important to me. I know it may be important to you too, and I don't want to make this harder than it needs to be. Can we talk about what each of us needs from this category and see if there's a trade that works for both of us? I'm willing to be flexible on fill in the blank other item if you're willing to work with me on this one. What this script does, it opens with honesty, acknowledges their interest, proposes a structured process, and offers a trade. It's not a demand, it's an invitation. Tool 3, the mediation preparation checklist. Before your mediation session, complete your personal property inventory. Know your 3 must-haves, things you will not trade. Know your 3 let it go items, things you'd be willing to give up for goodwill. Have your financial documents organized, account statements, retirement statements, mortgage statements, debt summaries. Write down your settlement goals, not position goals, not I want the house, but I'll need stable housing for the kids and sustainable monthly expenses. Know your BATNA, best alternative to a negotiated agreement. What happens if you don't settle today? What does trial look like? Bring your emotional grounding. Mediation works best when both parties can stay regulated. If you need to take a break, take a break. Tool 4, red flags. When to bring in a professional. Bring in a forensic accountant. If income is being hidden or minimized, business finances are opaque, lifestyle doesn't match reported income, or assets seem to have disappeared. Bring in a business appraiser, a CBV or a CPA ABV. If there's a business interest involved, there's a professional practice, or there are carried interests or partnership interests. Bring in a CDFA, Certified Divorce Financial Analyst, if you're considering a house for retirement trade. The tax implications of proposed settlements are complex, or you need someone to model long-term financial scenarios. Bring in a real estate appraiser if the home equity is in dispute, there are multiple properties or significant improvements. Bring in a divorce coach. That's me if you're feeling emotionally overwhelmed by the process, you need help preparing for difficult conversations, or you want strategic support navigating the system without the hourly cost of an attorney. Here's some rapid fire listener questions. Here's 4 questions from our community. Question. My spouse keeps saying they want the house for the kids. We can't afford it. How do I have that conversation? Start with the math, not the argument. I hear you, and I want what's best for the kids too. Can we look at the actual numbers together? What the monthly carrying cost is versus what we both bring in. I want to make sure that whoever takes the house can actually sustain it, because the last thing the kids need is a foreclosure 18 months from now. Then let the numbers do the talking. Question. Can I take things from the house before the divorce is filed? Talk to your attorney first. Removing marital property before a divorce can violate automatic restraining orders, which in many states attach the moment a divorce petition is filed and can create legal consequences. Document, don't take. Short answer, do not do anything with marital property without legal advice. Question. My spouse is claiming a business that was built entirely after we married is their separate property. Is that right? Likely no. In most jurisdictions, a business built during the marriage with marital resources, including your spouse's labor, which courts typically consider a marital contribution, is generally marital property, regardless of whose name it's in. There are exceptions. Businesses built entirely with premarital, separate, or property funds, but they're narrow. Make sure you get an attorney for this. Question. We agreed on everything. Do we really need attorneys? For the paperwork, at minimum, yes. Agreements need to be drafted, reviewed, and submitted to the court in legally compliant forms. A poorly drafted agreement can unravel, especially on retirement accounts, without the proper clause language. At minimum, each party should have an independent attorney review any settlements before signing. This is the one place where we agreed is not the finish line. So here's what we covered today. The Vitamix Principle. Small items carry symbolic weight that far exceed their market value. Name the dynamic before it costs you. The big buckets. Everything from real estate to cryptocurrency to pets is on the table, and whether it's marital or separate depends on your state and your documentation. The 10 flashpoints. The house, the retirement account, the business, the stock options, the debt, the heirlooms, the digital assets, and more. Each has resolution paths. Practical frameworks. Draft method, coin flip, sealed bids, point systems, photography, inventory day. These work. Use them. The math. Every dollar spent fighting is a dollar that could be part of your new life. Stop the bleeding early. Here's your assignment this week. Start your personal property inventory. One room, just one. Put it in a spreadsheet or on your notes app. Write down what you want, what you're willing to trade, and what you'd rather sell. This list is the foundation of your negotiation. All right, let's take this home. If you take nothing else from this episode, take this. The preparation you do before your mediation or going to court is worth its weight. Financial clarity equals negotiation power. When you have clarity, you have negotiation power. When you know what you have, what it's worth, what it means to you, what you need, you can't be bulldozed. You can't be manipulated. and you can't be taken advantage of. This is transformative divorce in action. This is you taking control of your narrative instead of letting the chaos control you. This is the reclaim phase, where you reclaim your financial power, your clarity, and your agency. Now, if you need help with this process, if you're overwhelmed, if you're not sure where to start, if you need someone to walk alongside you, this is exactly what I do as a certified divorce coach. And you can find me at www.reclaimandreboot.me. I work with clients one-on-one to navigate every aspect of divorce with intention and strategy, not just reaction and emotion. I've also written 2 books that can help you. You 2.0, Divorce, A Better Way Forward, and the You 2.0 Workbook, which is filled with practical tools and exercises for exactly the kind of financial preparation, emotional mastery, and co-parenting excellence. Both are available on Amazon and on my website. If this episode was helpful, please do me a favor. Subscribe to the Conscious Divorce Podcast wherever you listen. Leave a rating and review. It really does help other people find the show, and share this episode with anyone who you think is considering divorce or in the middle of the process. This information could literally help them plan for the future. You can also connect with me on Instagram at Reclaim and Reboot, or find me on LinkedIn. I share insights often on transformative divorce, co-parenting strategies, and life redesign. And finally, a huge thanks to everyone listening. Remember, divorce is not the end of your story. It's the beginning of You 2.0. It's the breakdown that becomes the breakthrough. It's a moment you get to redesign your life with intention. And it starts with being prepared. Thanks for listening. And I'm Justin, and I'll see you on the next episode of The Conscious Divorce.